Just when you think the real estate market can't get any crazier, it does. Hi, this is Andrew with the S2 Real Estate team of eXp Realty, and mid-February is upon us, which means it's time for my monthly real estate market update. So, as I just mentioned, this year has been quite a start, to be honest with you, in the way the market's moved so far. We've had several different unexpected things happen. And in the monthly market report for this month, one thing I want to touch on is inflation. I'm getting a lot of questions, and we are totally here amongst the team on, why buy now with inflation the way it's going? And, that's a question, to be honest, that only you can answer in whether or not it's the right time to buy. But I do want to share some information with you on why now may not be a bad time in the light of inflation. I also want to touch on mortgage rates. They have jumped, as you've probably noticed. It was expected that they would hit somewhere in the 4% range by the end of the year, and we're already there. They've moved substantially in the past month. So what does that mean for the market? Is it going to damper demand? Is it going to cool things off? What's the impact going to be of these rising mortgage rates? And then supply. One of the reasons, if you've seen any of the videos I've done recently, one of the overwhelming driver behind rising home prices and why they've been rising so rapidly is the imbalance that we've been seeing with supply and demand. And so we talked a lot last week about demand and where that demand is coming from. I've got a link to that video in the description below. And this week, I want to touch on supply just a little bit. For the most part in this country, we're going to see supply either from new construction or, as many hoped, you'd start to see supply from foreclosures. I know there's a lot of buyers that have been sitting on the sideline as everything's kind of gone wonky here, thinking that we're going to see a big wave, a tsunami, if you like, of foreclosure activity that's going to flood the market and cause prices to come back down. I've seen several reports on it. I've seen several people making videos on it, and I'm going to share the latest numbers with you and go back to what I've been saying the entire time. It's not going to happen. But in this video, I'm going to explain exactly why. All right, so let me share my screen with you here to jump into this month's report. So why buy now? In the face of inflation, is it a good idea to buy real estate when we're in an inflationary economy like we are right now? That's a question that we've been asked quite a lot, especially from some of our younger, newer buyers that are really kind of concerned. The price of everything is going up. When they're down at the store and they find that bread, milk, eggs, all of your household groceries are going up, gas is going up, everything across the board is going up, people get nervous, and it's completely understandable. Not only from the ability to afford, a mortgage, but also from the idea of, is it a good time to buy? If we're in an inflationary economy like this, what's it going to do to home prices in the future going forward? And I pulled this up here. It's from Investopedia. And as they say, real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns. Unlike paper assets, more specifically, as prices rise, so do property values. So what Mark's really saying here is that when you go back in time and look at periods of inflation, real estate has actually been a bit of a safe harbor. It's been a great place to park money. Now, granted, you have to be able to afford the monthly payment. I get that. But I also want to just point out and ask you to consider that rent is going up as well. So if you're in a situation where it's either buy or continue to rent, the one thing about buying is you lock your payment in for the length of the loan, most commonly 30 years. Whereas rent, that's not going to happen. And rent prices have actually been going up faster than home prices over the past couple of years. So again, I understand that the cost to rent is nowhere near the same as far as the entry goes. I did read a report over the weekend that was rather interesting. And it was talking about millennials and Gen Xers overwhelmingly saying they're unsure about whether or not to buy a home right now. And the interesting thing was, it's not because they were saying it was a bad market or there was concern about home prices, but they said with everything else, the cost of everything else rising, it was becoming increasingly difficult to save 20% for a down payment, which I thought was really interesting because you don't need 20% for a down payment. A standard conventional conforming loan, yes, it's 20% down, but you can do conventional financing with 3% down. FHA financing for 3.5% down. So the barriers to entry might not be as great as many people think that they are. And once you're in, you're in. You're going to get the benefit of appreciation and you're going to lock in that mortgage payment for the length of the loan, unlike the rent payment for hopefully the length of the lease. And they're going up substantially right now. So back to inflation as it relates to home prices. So let me move myself here for you. So right here, this is comparing home ownership, pace of appreciation with regards to inflation rate going back 50 years. So as you can see in the 1970s, the appreciation of homes on average for the decade outpaced inflation. In the 1980s, there was a lot going on. During that time, we had the oil crisis and the oil embargo, I should say, and it was pretty neck and neck. I mean, the inflation and home prices were pretty much even. In the 1990s, home prices edged up again over and above inflation. In the 2000s, it's kind of interesting here. You'll notice that for the decade, the pace of home price appreciation slightly trailed inflation rate. But keep in mind that in 2007, 2008, we had the market crash where home prices dropped fairly substantially. Even with that factored in and the drop in prices that existed, you can see that overall it wasn't that much different. People were not, if they'd owned their home through the entire decade, they still on average made money. It started to turn around again in the 2010s. We all know 2020 and then 2021, it absolutely took off and has been well above the pace of inflation. But the question is, what's going to happen as we go into the months forward, especially considering what's happened to mortgage rates? Now, as I mentioned at the beginning, it was widely expected that this year would end up at somewhere between about 3.8 and 4% on the mortgage rate. Well, we hit 4%. So rates have jumped substantially in the past month. So what exactly does that mean going forward? And to be honest with you, we haven't seen an impact yet. Are we going to? Sure, we will. But it really depends on, when you look at the mortgage industry, you are going to start to see reports about the overall volume of mortgages are down. The vast majority of that right now is going to be in refinances. So those people that live in their home that were refinancing from when they bought a few years ago to the record low rates we've been experiencing, those refinances don't make sense anymore. There's a lot of people, even at 4%, that were able to lock in lower than 4%, even going all the way back to 2014, 2015. So it doesn't make sense for those people to refinance. So you're going to see reports that mortgage applications or mortgage originations are down. There's a large percentage of that, as I mentioned, is refinancing, not necessarily on the home buy side yet for new buyers. And the reason for that is it still, even at 4%, makes sense. I strongly believe that we're moving back into an environment where rates will settle somewhere between 4 and 5%. Historically, that is still a phenomenal mortgage rate. But I want to show you a graph here, or a chart, that actually puts that into some perspective. So right here is a monthly loan payment calculator that shows you the difference. So I'm just going to pick a couple of them out here. Let's look at a loan amount of $400,000. Now, rates recently were running at 3.5%. That's a payment of $1,796 a month, principal and interest. At 4%, That same loan now costs you $1,910 a month. Yes, it's gone up. It's gone up $114 a month. So I want to keep that in perspective. Even though the rate jumped 0.5%, the payment went up $114. Is it significant? Depends on the borrower, right? But if you take $114 and multiply that by 12, it means that that home is $1,368 a year more expensive to own than it was just a few weeks ago. Not a lot of money overall. And for many people, they understand the fact that the home is appreciating much more than that in the next year. So the home is going to go up more than $1,368 over the next 12 months from everything we know now, guaranteed. So that's another way just to kind of keep some perspective on that. Now, again, if we just go down, we look at 500,000. Okay, so the payment's $2,245 at 3.5%. And at 4%, it jumps to $2,387. It's a difference of $142 a month, or $1,704 a year. Definitely more expensive, but not enough at this point in time to make or break for many of the buyers out there. Now, only you will know what makes the most sense for you. And if you're in the process of buying, I suggest that you do speak with the mortgage loan officer that you've been working with and make sure that you get locked in if you're able to do that at this point, and have another look at the numbers to see where those numbers play out. Now, this is going to have a bigger impact on entry level buyers, those trying to buy their first home. This is going to make a difference, right? It's definitely going to impact them, and it will, based on the affordability changing, push some buyers out of the market right now. Overall, though, for the long term, again, we've been dealing with a massive imbalance between supply and demand. So if we get a little bit lessening of demand based on what we're looking at currently with supply, that's not necessarily a bad thing. And if anything, it's not going to cause home prices to stop appreciating, but it should lower the pace of appreciation that we have being seen. So going back to that imbalance between supply and demand, if you think about it, really, there's only two places that we're going to get supply, and that's resale homes and new construction. And, you might be asking, well, why is supply so low? Well, the home builders underbuilt. We were oversupplied in the early 2000s. And since then, we've been undersupplied, and we continue to be undersupplied now. But the challenge that we've had is when the pandemic hit, massive supply chain issues. We know that in everything. I'm sure that you've all been to the grocery store, you've all been out looking, and all of a sudden the shelves aren't as packed as they once were. It's harder to get things. Same is true for new construction right now. So here I am based in Texas, and here in Texas, what we're seeing is we have massive new construction here, but there's virtually no new construction projects with available property right now. It sounds crazy, but when we talk to the builders, I was on a conference call with Beazer Homes just last week. I was on with Highland Homes recently, Pulte Homes just before that, and they're all saying the exact same thing. If it's not windows, it's brick, right? Shortages, supplies. Sometimes they're 4 months out getting deliveries. Beazer were saying appliances have been a huge issue for them. They haven't been able to get appliances and are actually trying to get loaner appliances just so they can close on a house, knowing that a month or two later, they're going to come in and swap out the oven or swap out the microwave. Not only that, even to get final approval, there's a delay and a backlog right now getting electric meters and not electric meters, gas meters. Gas meters have been a huge issue. So you've got this supply chain crunch that's majorly impacting new construction and causing many projects to be pushed out until later this year or even into 2023. One of the hopes many people had for supply was that we were going to see a wave of foreclosures. Remember, when the pandemic hit, there was all kinds of reports, all kinds of videos that, oh my gosh, the market's going to crash. This is going to happen. That's going to happen. This is going to be worse than 2008. There were a few of us that said, No, it's not. It's not the same thing. The banks learn their lesson. They don't want to own homes. And this is not the same as what happened before. And again, I'm going to stand by that today, that if you're hoping that there's going to be an influx of foreclosure properties, it's not going to happen. There's nothing anywhere to indicate it. And here's the numbers to back that up. So let's look at loan forbearances. Okay, so you might remember that right after the height of the pandemic hit, right after all of the lockdowns, the shutdowns started, for those people that needed financial assistance, the number of homes entering mortgage forbearance was pushing 5 million homes, or 5 million loans, I should say. Okay, so that's where we were back in May of 2020. And that number has continued to fall over time. The latest numbers, according to Black Knight, as of January of this year, is that there's about 780,000 homes remaining in forbearance. 780,000. Okay, so that's a big drop in where we were. So what happened to all of those others? If there were almost 5 million and now there's 780,000, what in the world happened to all of those homes that were in forbearance that are now no longer in forbearance? Was Andy Walden from Black Knight says, as the COVID-19 pandemic continues to create uncertainty in the global economy, the overwhelming majority, 89% of single-family homeowners who sought financial assistance through COVID-related mortgage payment forbearance plans have exited those plans. That's what that graph I just showed you indicated. They have now exited those plans. So here's what's actually happened to those loans that have come out. 38.1% are paid in full. Now, they're either paid in full from the perspective that the mortgage was paid off, or they never needed it and never stopped their mortgage payment in the first place, or the past due payments have now been brought current. So 38.1% have been paid in full. 43.7% have worked something out with the bank, a loan deferral, where the amount that was passed has been added to the end of the loan, or a loan modification where the terms of the loan have been changed. But on that, that still means that 18.2% are in trouble. Well, again, that's still a large number, right? So according to Black Knight, though, out of those 18.2%, 93% have at least 10% equity. That's huge. Have at least 10% equity. Prices have gone up so much over the last couple of years that many times, or in many of these situations, even if someone wasn't paying their mortgage, they're finding that the amount that they previously owed, the missed payments, the home was appreciating faster than the late charges and the missed payments were being added to the loan. So what that's resulted in is, 93% of them have at least 10% equity. That is a key number, because when someone has 10% equity in their home, they can sell it traditionally through an agent, pay off all of the fees, pay off the loan, and have money to move. Okay, so if you look at that, that means only 7% of the homes remaining in forbearance are the homes that could be in trouble. Now, again, don't get me wrong, 7% of 783,000 is still a very large number. But for people to turn around and say, oh my gosh, this is just like 2007, 2008 again, all over again, this is what we're looking at coming forward. No, it's not. Take a look at this. Okay, so if we go all the way back, and remember, foreclosures are a part of the market every single year. They're always with us. Somewhere right around 290 to 300,000 homes a year are foreclosed on average, in good years and bad. That's the average if you go back. But take a look at this. I mean, even if all of those homes remaining in forbearance, all 783,000, let's imagine for just a minute that unfortunately they all get foreclosed on. Okay, that 783,000 doesn't even equal the amount of foreclosures we saw in 1 year between 2007 and 2015, let alone what we saw here cumulatively. start adding those numbers up: 1.3, 2.3, 2.8, 2.9, 1.9. You add all those up between 2007, 2015, and compare them to where we are today, and you can get a better understanding of the overall breadth of the problem or potential problem now compared to what we saw then. It's night and day. It's not the same thing at all. So the idea that the market's going to crash because of foreclosure activity, none of the data validates that. None of it backs it up. So if you're one of the people, someone that's waiting for it, are there going to be some short sales and some foreclosures in some markets? Yes, but certainly not enough to have a major negative impact on the housing market as it stands right now. Again, could things change? Sure, they could. Things can always change. But based on what we're seeing right now, that is just not going to happen. And lastly, as Mike Claire Bolton Smith from CoreLogic points out, we may see a little bit of an uptick in foreclosure rates in 2022. Just an uptick, though, from an extraordinarily low level. We're not expecting to see a big increase. We expect delinquency rates overall on home mortgages to actually continue to remain quite low. And again, I brought that up before. One of the reasons for that is the fact that a lot of these homeowners gained equity. So if somebody is really in trouble, they could simply put their home up for sale and be able to clear all of the obligations and the debt. I don't wish that on anyone, and I hope that doesn't happen. And it's not going to happen like it did before. But again, the market right now remains pretty crazy. Inventory here in North Texas, here in Frisco, remains critically low. We're still seeing multiple offers and bidding wars on almost every property. As a matter of fact, this past weekend, I was in Northern California. I saw more for sale signs there than I did out here. But at the same point in time, they're still experiencing the same thing. I mean, homes listed for 2.2, 2.3, 2.4 million are receiving multiple offers and selling. The one I saw sold for $750,000 over the list price. So again, it's unique right now in that it's impacting all areas in all price ranges. So as we move forward in 2022, we do expect the price appreciation will moderate. Demand will be impacted by the rise in mortgage rates. And this year looks as though it's still going to remain a little bit of a challenge for home buyers out there, especially with builders struggling to bring new inventory to market. So I hope this information helps you. If you find that you still have questions or a specific situation that you'd like to talk through, please feel free to reach out. You can give us a call at 888-447-9650 or send an email to contact@s2realestateteam.com. And we're always happy to talk to you and help in any way that we can.